Welcome, everybody, to another hype session with your boy, Raj Nation, the startup hype man. This is being broadcast to you on Instagram TV and simulcast on LinkedIn, as well as audio shared through Startup Hype Man, the podcast. Today on our hashtag hype session, I have welcomed BJ Lackland, the CEO of Lighter Capital, into the room. BJ and Lighter Capital have a pretty awesome mission here because Lighter Capital is the most active revenue-based financing provider in the United States. BJ, welcome to our little conversation. Welcome to our hype session. Tell us, what is revenue-based financing?
Great. Listen, thanks, and I'm happy to be here. Revenue-based financing is really an alternative way to fund a startup. Actually, it's an alternative that's going much more mainstream. But essentially, think of it as some of the best aspects of debt and equity combined together into one form of financing. Now, structurally, a little more specifically, it's a royalty agreement, essentially. So, for example, we give a company, say, $500,000. They then pay us a percentage of their revenue each month until they've paid us a set multiple of that $500,000, typically like 1.5 times or something. So we give a company $500K. They pay us, say, 5% of their revenue until they paid us $750K total. We'd expect that to be over like 3 to 4 years. And if they grow really quickly, they might pay us faster, in which case we make a higher rate of return, kind of like an equity investor. If they grow more slowly, then we make a lower rate of return. And we're taking that risk. So the whole goal with it is to set up a structure where we're very much on the side of the entrepreneur, like equity. And yet, at the same point in time, we don't take any equity ownership. We don't have any control. We can't fire CEOs. You don't take board seats. So it's very much like debt in that it's much more of a hands-off type of experience from a control perspective and dilution perspective.
It's funny you mentioned it was the alternative that went mainstream. To me, it's you're basically like the hip hop of the music industry, but you're this of the finance of the investment industry, because hip hop was the scoffed at alternative for a long time, which has now become the most mainstream genre of music out there. So perhaps
maybe we'll reach that. Probably not quite hip hop yet, but I love it.
Still, we're like early 90s, mid 90s hip hop in terms of revenue-based financing. So thank you for sharing that and giving us the lowdown on Lighter Capital. Tell me, when we think about startups raising money, we traditionally think about VCs. We think about angel investments, which are equity-based investments. Tell me and tell our viewers and our listeners why Lighter's model is a nice, healthy alternative to that.
Yeah, it's a great alternative, partly because no loss control and no dilution. But really more broadly, if you think about how to finance your startup, it's essentially just another tool in the entrepreneur's toolkit, because it actually works really well in conjunction with venture capital or completely on its own without raising venture capital. Typically, the entrepreneurs we see come in and they are one of two minds. They're either kind of thinking, well, we want to raise VC later, but we don't want to do it now. We want to delay it for a while. Or I never want to raise VC. I don't want to give up ownership of my company. I want to keep control of the whole thing and I want to run it forever, or at least I want to be able to sell it tomorrow if I want. I just want to keep open the options and keep the control. So there's the VC later folks and the VC never folks. And revenue-based financing works really well for both, because for the VC later folks, it gets you some capital now to kind of reach that next milestone, go grow for another year or two. And so you'll get a better valuation out of it. A lot of the companies that we fund fall in that category where they might get like $1 million in revenue and they just really want to get to like $3 million in revenue and just put off doing a big dilutive round. They want to have more control. They want to set the terms more, all that kind of stuff, so that they can really get the equity deal they want. Then there's the folks that are on the VC never category. And for most of them, there aren't a lot of good options to get a lot of capital. And you can go to a bank, but you're going to be signing a personal guarantee. And the bank's going to be really conservative. So a bank might be able to give you $75K, where we'll give you like $400K. Banks are just not built to fund SaaS companies. In fact, in a lot of ways, SaaS companies are like Teflon for a bank. They don't tend to have hard assets. They don't tend to be positive or they tend to be, burning money a little bit at least. and they don't tend to have accounts receivable very much because a lot of times they get prepaid for future services. And so banks are like, I love your business, it's growing quickly, but I can't do a thing for you in terms of providing capital. So really, backing up to your question, it's really an instrument that works well either direction, whether you want to raise capital from VCs in the future or whether you want to just never go raise from VCs at all and just go and grow and grow and grow. And on both those scores, we see companies go on and have incredible exits. One of the companies that we funded years ago went on to raise about 60 million in VC and just sold to Salesforce for a ton of money, hundreds of millions of dollars. Another company that we funded that never went on and raised VC just went and sold for like $100 million, and the entrepreneurs still own the vast majority. Is crazy.
That's an awesome story.
Yeah, those stories, we see a lot of entrepreneurs that never raise VC and they'll go sell for like $30 million and it'll never hit TechCrunch or GeekWire or any of the major media, but it made the entrepreneurs a ton of money. They did really well, but they controlled their destiny the whole time. A lot of those are actually the more beautiful stories, frankly, that we see.
We are with BJ Lackland, CEO of Lighter Capital, on this hype session. BJ, 2 final questions for you. First, can you let the viewers and the listeners know how big is the portfolio at this point? How many companies are you financing and all those numbers?
Yeah, we will fund about 200 this year. We funded 90 already so far, and usually Q4 is almost as big as the couple quarters before it. So we're on track to fund about 200 companies this year. Our fundings are relatively small. Average funding size is in the hundreds of thousands of dollars. We'll provide up to $3 million per company, but average funding size is about $300,000 to $350,000. But we'll do $1.5 million deals. We'll do $50,000 deals. We have funded 330 companies so far with about 590 rounds of financing. So we typically provide 2 rounds of financing per company, but we've provided 8 before to one company. That company actually started as a $50,000 loan, and now we've got about $2.5 million, and they're doing about $14 million in revenue. And they've raised some angel money, but they've never raised VC yet, and now they're thinking about raising VC for the first time. So you can imagine the power of raising VC for the first time when you're at 14 million in revenue. It's great for the entrepreneurs.
That is awesome.
Yeah.
So what types of companies make sense for Lighter Capital, and who should be contacting you?
Yeah, a lot of SaaS businesses. We fund a lot of B2B SaaS, but we also fund a lot of tech-enabled services, anything that has a recurring kind of predictable revenue stream and that's relatively high margin, like that's software enabled basically. Anything like that is something we'll really look at. And besides revenue-based financing, we're actually starting to provide lines of credit for accounts receivable and some just standard term loans and stuff as well. So we're really broadening out our scope to fund a broader section of companies. So even some more services-based businesses and things as well. Sometimes those companies don't get as much love even as like the SaaS entrepreneurs, but they're great businesses and they're great entrepreneurs making great businesses and employing more and more people. So a lot of SaaS, but a lot of anything that's just recurring is great for us.
Where can the audience learn more about Lighter Capital?
Yeah, obviously our website is a great central point for that. And we've got some ebooks we made and things like that. Or just contact us. Frankly, if you're an entrepreneur that's got a business and you got some revenue, you can either just like apply through our website, which is a simple thing, and get in contact with us, or even just write into info at Lighter Capital and say, hey, I'd love to talk to somebody about future financing and such, because we'll talk to companies all the time. We're not snobby. One of our internal values is being really highly accessible to entrepreneurs. So as opposed to a VC where you have to get like a warm intro.
Not sitting in the ivory tower, yeah.
You don't need that at all with us. Like as long as you got sort of business and revenue, like we'll talk and kind of tell you what we do and tell you what we can and we can't do. And a lot of times try and refer you off to somebody else if we can't do today.
Final question. I need a lightning response from you. Fill in the blank. Entrepreneurship is
a struggle.
Entrepreneurship is a struggle. I like that. He is BJ Lackland. He is the CEO of Lighter Capital. The website is lightercapital.com. This has been another edition of a #hype session brought to you by Startup Hype Man. I am Raj Nation. We will catch you on the next one. Hype Man out. Word up. Raise up.